Have you ever looked at a set of numbers that just don't seem to add up? Like, how can a bank be growing its business by almost 20%, but at the same time see its profits fall by a third? It sounds like a paradox, doesn't it? Well, that's the exact puzzle we're looking at today from Suryoday Small Finance Bank's latest results. So let's dive in and really unpack what's going on behind the scenes. So just to set the stage, Suryoday is a small finance bank. Their whole mission is to bring financial services to communities that are often overlooked. Because of that, when they release their financial results, people pay close attention. And what everyone saw this past quarter, well, let's just say it was a mixed bag. The numbers painted a picture of a bank that's somehow moving in two completely different directions at once.
And boom, this slide really just lays out that paradox perfectly. On one side, you've got their gross advances, that's just a fancy term for all the loans they've given out, growing by a super healthy 18.9% from last year. That's great news. But then you look at the other side, their bottom line, the actual profit, and it's taken a nosedive, down by 33%. So they're lending more money, but they're making a lot less.
So you've got to ask, right? If the main part of your business, lending money, is actually growing pretty well, what in the world could be strong enough to just slam the brakes on your profits and throw the whole thing into reverse?
And the answer, the real villain in this whole story, comes down to just two words: bad loans. You see, for any bank, the most important thing is the quality of its loans. And for Suryoday, this has been the one issue putting a ton of pressure on their finances and, as we just saw, on their profits.
Now, you're going to hear this term a lot in the finance world, NPA, which stands for non-performing asset. Let's just cut through the jargon for a second. An NPA is basically just a loan that's gone bad. The person who borrowed the money has stopped paying it back. So for the bank, that loan is no longer performing. It's not earning them any money. It's a bad loan. Simple as that.
And check this out. This is where you really see the scale of the problem. A year ago, the bank's bad loans, their gross NPAs, were at 2.9%. Not too bad. But fast forward to this year, and that number has more than doubled to 5.9%. This isn't just a small blip on the radar. That's a huge jump that signals there's some real stress in their loan portfolio.
Okay, so here's why that matters so much. When your bad loans double, it's like a 1-2 punch for the bank. First, you stop earning any income from those loans, and second, you legally have to put money aside just in case you never get that loan money back. So you've got less money coming in and more costs going out. And well, you can do the math. That goes straight for the profits. And suddenly our puzzle starts to make a lot more sense.
Now you'd think a problem this big could be a total disaster, right? Especially for a smaller bank. But, and this is where the story gets really interesting, Suryoday didn't just stand there and take the hit. Turns out, they had a pretty clever safety net already in place.
So the question is, how do you protect yourself when bad loans are piling up like this? How does a bank build a shield to protect its finances? And their secret weapon? It's called the CGFMU scheme. The easiest way to think about this is like an insurance policy, but it's from the government. The bank can pay into this fund to cover some of its loans to tiny businesses. And if those loans go bad, the fund steps in and covers the loss. It's a brilliant way to reduce risk. And get this, look at that number. 313 crore rupees. That's the amount the bank claimed and received from that government scheme just this past September. That one move basically wiped out a huge chunk of their potential losses and helped stabilize the whole ship.
Okay, so that guarantee was a fantastic short-term fix. A financial band-aid, if you will. It stopped the bleeding. But the bank knew you can't live on band-aids. They needed a whole new game plan for the long run to make sure this kind of thing doesn't happen again.
And the heart of this new strategy is a really big shift in who they lend to. For a long time, they focused on what are called group loans, where a whole group of people are on the hook together. Now, they're shifting hard towards individual loans. The thinking is, it's just a more stable and less risky way to lend money when you're assessing one person's ability to pay you back.
And if you want to see just how serious they are about this change, look at this chart. Within this specific loan portfolio, individual loans, which they call Vikas loans, now make up 70% of the business. That old group loan model, it shrunk all the way down to just 30%. That's not a small tweak, folks. That is a complete overhaul of their lending DNA.
And at the same time, it's not just about who they're lending to, it's about how. They are going all in on digital. I mean, look at this. They've pulled in over 1,300 crore in deposits just through digital channels.
They've teamed up with a massive player like Paytm to get credit out there right on UPI, signing up 50,000 new customers super fast. And they're not stopping. They're rolling out even more digital products.
So, okay, they've put out the immediate fire. They've drawn up a new blueprint for the future. But what's actually next? Where does Suryoday Bank go from here?
Well, the game plan for the rest of the year is super clear. They want to work more with small and medium-sized businesses, grow their portfolio of safer, secured loans, and really double down on their new individual loan strategy. And of course, they want to keep bringing in those low-cost deposits. You know, the money people just park in their checking and savings accounts. That's the cheapest source of funds for any bank.
And you can really hear the confidence coming from the top. The CEO, Bhaskar Babu, basically said, hey, we're seeing things get better. The stress is easing up. He's looking at the next 6 months as a steady recovery period, which he thinks is going to set them up for some really strong growth next year.
So that brings us right back to where we started. Suryoday Bank faced this crazy situation. Business was growing, but profits were falling. They pulled a clever move with that government guarantee to shield themselves in the short term while completely changing up their strategy for the long term. The real question now is, will it work? Can this new playbook actually turn today's big challenges into tomorrow's success story?